What's good, everybody? Mokama Sunday service. Today, we're going to be talking about the earnings reports of four of the largest companies in the world. I'm contemplating right now what I should buy. Specifically, we're going to be talking about all of these names here. This last week was a big week to determine like whether or not these companies are actually making money or not, right? I'm Omar Reed. I have a couple $100,000 in the market. I'm an attorney who trades and I invest in my spare time and I look at the market pretty much every day, right? So the specific reports we're going to be going over: Microsoft earnings reports, Meta earnings report, Apple earnings report, Amazon earnings report. These are like the companies in the $1 trillion club. All of these companies are worth more than $1 trillion. Microsoft, at least right after earnings, surpassed $4 trillion in market cap value, right? So these are four of the largest companies in the world, specifically in the US as well, all right? Let me get out of here. All right, so let's start with Microsoft earnings. If you want to find the earnings reports of a company or any financial data for a company, what I would do is I would Google that company's name and investor relations. That company's name, for instance, Microsoft Investor Relations, and then go to that web page. That web page will give you a bunch of information, financials from previous quarters, recent earnings releases, uh, in multiple formats most of the time, right? So that's how you go and specifically look for the earnings of a company. And generally, right when they release, you're going to see the links pop up to where you can download this data. And then, generally, about 30 minutes after they drop the data and drop the earnings to the press, right, then they're going to have some sort of web call or audio call and speak to their shareholders. Sometimes it could be the CEO, the COO, a spokesperson, CFO, or a combination of those folks, right, that are going to give some forward guidance for the company. Most of the time, sometimes they don't. Especially if things are in the future look bad, they may not give forward guidance, or if things are uncertain, right? So that's what I mean by earnings reports and earnings releases is specifically the data that comes out telling you how much money was made or lost during that particular quarter, and the earnings call that happens right after, right? So if we look at Microsoft, what did Microsoft do? They made $76.4 billion in revenue last quarter, which is 16% or which is 18% growth overall. In the specific sectors, they have three particular sections where they like segment off their revenue: productivity and business processes, intelligent cloud, and more personal computing, right? And one of the things I think with investing in any company, especially as a beginner, you should know what that company does or sells. Like, how does it make its money? And we're going to go into these specific segments later, and they define these in the slides. But that's one of the first things that you should do when analyzing like the fundamentals of a company. Is like, what does it do or sell? Um, how do you know if this company is going to be around for another 5 or 10 years if you don't know what it does or sells, right? But if you look at these numbers, they look amazing, right? Specifically, the cloud growth, right? The cloud was already growing, but they had 26% growth with Microsoft Azure, right? And that's like their new vertical that's like killing it right now. Um, so yeah, Microsoft's revenue growth, revenue potential looks really good. Their operating income or their profit or net income, actually, this is a little bit different than their net income, is up 24%. And so essentially they're profiting $27.2 billion off of this 76.4 billion in revenue, right? So those are pretty decent margins as well. That's So one thing that I've been paying attention to with a lot of these major companies is their capital expenditures. And why that's important to me is because I own Nvidia, 275 shares of Nvidia. And I also own some AMD Leaps. I own some ASML. So I know right now that these massive companies are spending a lot on their AI infrastructure and data center infrastructure. And if these particular capital expenditures are going up, then I know that's probably going to Nvidia and a lot of these companies that I own. So this is kind of like a proxy for other things and other sectors for me. So here their capital expenditures were 24.2 billion, up 27% year over year, specifically to support demand in their cloud and AI offerings. And for me, I hear semiconductors, I hear chips when I see that. So I'm like, okay, so these massive companies, the biggest companies in the world, are still spending more money on chips year over year, which bodes well for the semiconductor sector. And that's a kind of a tangent, but just how this affects me and why I go through earnings reports, right? Um, so here is where they tell you what they include in each segment, specifically for Microsoft, right? So the productivity and business processes segment is Microsoft 365, right? Microsoft 365 consumer products and cloud services. LinkedIn, I don't know why this is looped with these, but LinkedIn, even that's up 9%. And then some Dynamics products and cloud services revenue, right? And then they have their intelligent cloud split up separately, which is their server products and cloud services revenue, which is driven by Azure. That's up 27%. And then the other cloud services revenue growth of 39%. I assume some ancillary products that they're selling with that. And then the more personal computing segment is Windows, their old school product. Uh, this is what started it all. But as you see, the Windows OEM and devices revenue only increased by 3%. So if Microsoft hadn't gotten these other verticals up, like its old school Windows business looks like it's growing like the slowest out of all of its other segments. Xbox is growing at a decent rate. They're up 13%. And then search and news advertising revenue is up 21%, right? So Microsoft, great company, a lot of different products and services, and most of them are up except for its initial product, which was Windows, which seems to be growing the slowest. But still growing, if you want to be positive about things. Let's see. Where's the balance sheet? Do they have the balance sheet in here? No. If I go here, let's look at their financials. And this is what I'm saying. If you go dig around the site, you don't see certain things. You could generally go find it, right? Oh, here, the balance sheet. So I always look at the balance sheet to figure out how much cash or what's the asset to debt ratio. And of course, I want to see at least a 1-to-1, which means you at least have enough assets to cover your debt. But like the best companies have like 2-to-1, 3-to-1, 4-to-1 type of ratios, right? Where they just have so much cash or cash equivalents on deck, right? So they can invest or buy up anything or any opportunity that comes. Here, looking at Microsoft, it has $30 billion of just pure cash on hand. And in the short-term investments, $64.3 billion. So just the total cash it has is $94.5 billion. From an asset standpoint, it has $191 billion of total current assets. And total assets overall, $619 billion. Goodwill is 119.5. I guess Microsoft, if any company, could say that, but I usually try to discount this number more than anything else, especially for other companies that aren't like a Microsoft. Because, like, how do you really value goodwill? But, even if you include that number, $619 billion of assets, and the total current liabilities, $141 billion, Total liabilities 275 billion. So they're about a 3-to-1 asset to liability ratio. If you're looking at total current assets, it's like 1.5 to 1 versus total current liabilities, right? So is Microsoft going to go out of business anytime soon with just having 94.5 pretty much $1 billion of cash lying around? I don't think so. It looks like with all the property, equipment, and things of that nature, 619 billion versus 275 billion dollars in liabilities. It's like 2.5 to 1. Microsoft is in good standing. Is going to be able to withstand um, any downturn, right? Which we may be going into some seasonality into August and September, right? So Microsoft earnings, I thought they were great. They beat expectations at least a day after before that dive that we had on Friday. The stock was up, right? So now let's get to Meta, the second company we're going to talk about. Meta owns Instagram, Facebook, WhatsApp, primarily a social media company, right? It's an advertising company. Yes, it sells the Ray-Ban glasses, and it's getting into the augmented reality space. And I looked at these last week, so this isn't the first time me looking at these. I know that all of its revenue is coming from advertising dollars. The augmented reality stuff is actually a net loser right now, but all of that is offset because the advertising revenue is booming, right? So if you look at the revenue, $47.5 billion this quarter, up 22%. The income from operations is $20.4 billion, up 38%, which is crazy, right? So Meta increasing its margins, it looks amazing right now. The net income, $18.3 billion, up 36%, right? It's figuring out a way to increase its margins, and even though it's a one-trick pony in terms of like what it sells and what's bringing in money, man, this is still like a cash cow business right now, and it definitely beat expectations, right? So I would say it may have had the best earnings report out of the four that we're talking about today. Microsoft reported great earnings too, but Meta increasing its margins and growing its net income 36%, that's just an amazing feat, right? So looking at its balance sheet, um, it has what? And let's say total current assets 73.6 billion, total assets 294.7 billion. Not really valuing goodwill that heavily, which I love to see. And if you're talking about versus total liabilities, it has 99.6 billion, so it's like 3-to-1 asset to debt ratio, which is great, right? Meta's not going out of business anytime soon. And here's what I wanted to show you. So the revenue, if you're looking at the split, all ad revenue, $46.5 billion came in from advertising. Less than a billion came in from something else, maybe some subscriptions. The reality labs, so you're talking about the augmented reality stuff, it's costing way more than it is than it's bringing in. So it only brought in 370 million. You're talking about the glasses, the goggles, the augmented reality stuff, only brought in 370 million. How much did they spend on that? They spent $4.5 billion to only bring in 370 million. So like the apps, the advertising revenue from the apps, that's what's bringing in all of the income. And so far, like they're trying with the augmented reality and the glasses, but it's a net loss to the company. In fact, like if they would have eliminated that part of their company, their total income would have grown even more than that 36%. So yes, you got to take some swings. They're doing some R&D, but so far it's still advertising, right? So that's how I would analyze Meta. great company. The main issue I see, or that's holding it back from being even better, is the augmented reality side. But Zuckerberg is taking a position and trying to stake a claim for the future of technology, and so they're spending a ton of money on R&D, on AI, on chips, on the augmented reality sector, because they can, because they're just bringing in so much damn money that they can. I do want to see. Let me see if they have information about their capital expenditures, because I know Zuckerberg has been spending so much money poaching AI talent and building centers. I wonder if they have. This is Control F. No, I don't. At least I don't see it in here where they've like detailed how they're spending. Here it is, right here. We currently expect 2025 capital expenditures to be in the range of $66.72 billion, narrowed from their prior outlook, and up $30 billion year over year. Yeah, and here it is. We currently expect another year of similarly significant capital expenditures dollar growth next year as we continue aggressively pursuing opportunities to bring additional capacity online to meet the needs of our artificial intelligence efforts and business operations. So what does that tell me? They're spending more money on chips. So Microsoft is spending more money on chips next year. Meta is spending more money on chips next year, which is why I'm not selling my Nvidia anytime soon. Right? Once again, like, I'm being selfish right now, but that's what I'm looking at in all of these reports. All of these trillion-dollar companies are spending more money on chips if they're all trying to increase their artificial intelligence efforts and capacities. They're spending more money on chips and cloud, which benefits Nvidia, AVGO, AMD, TSM, ASML, right? So chips are still going to be, it looks like, solid in 2026, and it looks like they're spending more money, right? All right, now let's go to Apple. So Apple, this is the one that surprised me. Even though the stock price didn't react so well to these earnings, but they blew it out of the water, right? 94.03 billion in total revenue, up from the quarter of last year at 85.7, and that's a significant growth, right? So that shocked me. The products revenue was up and the services revenue was up, right? Um, let's look at the net income. Net income up to 23.4 billion. And if we're looking at the sales, up in America from 37.6 billion up to 41.1 billion. Europe, it was 21.8, now it's up to 24 billion. So there's some good growth in America and Europe. Even a little bit of growth in China. We have been seeing dipping sales in China. That's up slightly in Japan as well, and the rest of the Asia Pacific. So they had a really strong operational quarter, especially for still only having the exact same products that they always have, right? The iPhone sales are up. I don't know how that's the case, but they're up 44.5 billion. So Tim Cook figuring out a way to still keep hawking these damn iPhones, same product over and over again, right? And so Mac sales are up, iPad sales are down. If there were any negative, that's it, right? Wearables down as well, and but the services revenue is up. So that's Apple. Let's look at their cash. See, this is my problem with Apple. Apple has all of this cash lying around, and it just, like, what is it doing with all this money, right? $122.4 billion in assets, like, in terms of cash around, like, if you add the cash and the marketable securities, Apple has, like, what, $54 billion of cash just sitting. You never hear of any, like, flashy acquisitions or It's hopping into the AI market. It kind of just like let AI alone. So I'm like, what is it doing with all this money that it just has? Like, and total assets, I don't even see any goodwill in here. $331 billion, and total liabilities 141. So it's a little bit greater than 2 to 1. So Apple's not going anywhere anytime soon. Actually, I'm sorry. That's total current liabilities. Total liabilities. So it's like 1.5. Still, Apple, all this cash, all this money, not even valuing goodwill. This is probably one of the companies that could. And yeah, it's up definitely greater than 1.1. Not as great as Meta's asset to debt ratio, which is why I would rank Meta on top of Apple. I would also rank Microsoft on top of Apple in terms of like what I would want to buy in my long term portfolio right now. Um, but I wouldn't hesitate to put some leaps on Apple if it keeps falling, right? But overall, um, I forward looking for Apple. It needs another product, it needs another service, it needs another vertical to supplement its iPhone. But most of the people that I know with iPhones don't plan on switching anytime soon, at least in the U.S. And apparently in Europe and China, their sales are up too. So, man, it's the one trick pony that keeps going. So as of right now, I still think it's a good company, a better company than most in the market to have in your long term portfolio. I would probably swing it with some leaps, do a long term swing on it, and maybe keep some of it. But right now, I would say I would rank uh, Meta and Microsoft ahead of Apple if I had the opportunity to buy one of these things on a pullback. Right. Fourth company, Amazon. Uh, oh, here it is. So Amazon, what did it do? Amazon's reporting is always backwards than all of these other companies, right? They put their 2024 over here and the 2025 here, right? So it looks like they took a loss if you're reading these quickly, but in fact, the earnings were they had a crazy beat on their earnings, right? Um, um, Net revenue up from 147.9 billion dollars the same quarter of last year, up to 167.7 billion dollars. That's crazy. They make 167.7 billion per quarter, right? So that's what they made. Their product sells 68.2 billion. Their service sells 99.4 billion. That's how they segment their revenue, right? But that's so crazy, right? In terms of how much money Amazon makes. Um, but also look at their operating expenses. So they make that much money, but it costs a lot for Amazon to operate. So $148.5 billion went out the door when 167.7 came in. So that's the main thing. Amazon is just constantly worried about growth, and that's like their motto is like grow at all costs. Um, and if they wanted to, they could really start working on their margins, but they don't. So you'll see like the cost of the goods sold, specifically like all of the Amazon products, like if you're talking about not AWS stuff, but Amazon.com and all of the stuff that they sell. That stuff to actually have physical things, it's expensive, right? The fulfillment, the centers, the technology, the sales and marketing, all of that's really expensive, right? So the margins aren't as high on Amazon as like Microsoft, Meta, right? That have high margins because they're selling ads or selling software, which scales better than like selling physical things, right? But you look at the net income up from 13.4 billion of the last quarter of last year to 18.1 billion. So it's still growing profits, right? Just a slightly different business model than the other giants that we just talked about. Here we go. Here's the segment information. This is probably the most important page when you're looking at Amazon revenue to kind of get a sense of what the company is doing. So if you're looking at Amazon.com sales, right, online sales, net sales in the U.S. or North America, $100 billion. But look at the operating expenses, 92.5 billion. So the income that it gets from all of this revenue is not that amazing, right? 7.5 billion versus what we just saw with Meta. Internationally, the same thing, brought in 36.7 billion, but the profit was only 1.4 billion. So where does the profit come from? The profit comes from AWS, the cloud computing segment, right? Which is, oh, and this is interesting to me. So AWS used to be the big behemoth and the only behemoth out there in cloud computing. It was the number one. It still is number one, right? 30.87 billion. But if we go back to Microsoft, where is cloud? Microsoft caught AWS. That's crazy to me, right? I'm just because I've been tracking this for a while and AWS had the lead. Now Microsoft is almost tied. So it's reporting 29.9 billion in cloud revenue and AWS reported third only a billion, maybe like no, $873 million more than Microsoft in cloud revenue. So it looks like Azure caught hawked AWS. I didn't think I'd see that happen. And then I looked at Google's numbers last week. I think they were at 20 billion. So like these cloud computing services, AWS isn't. I don't think AWS is the front runner anymore. It's still growing, and like look at the revenue growth from 26.2 to 30.8, and the operating income. It's still Amazon's cash cow, but it seems that there's some parity between AWS and Azure now. And then like a few quarters ago, I had been hearing that companies had been using both because if one failed, they wanted to have like some have some duplicate processes, just some resiliency. So in case something happens, AWS goes down, then Azure's up. If Azure goes down, then AWS is up. So they've been kind of duplicating their cloud services. So that could be that. But AWS isn't significantly further ahead than Azure now. So I would say those are like 1A and 1B right now in terms of revenue coming in, which is interesting. But as you can see, so about 9 billion, 8.9 to 9 billion came in from Amazon.com sales, but all of the rest of the money came in from AWS, right, which is the cloud computing. So that's the largest, like, that's the most important business to Amazon. This could almost be its own business outside of Amazon, would be its cloud computing segment, right? And sustained growth there is where Amazon is really going to make their money unless they start squeezing all of the people that are selling on Amazon. But it's really not making that much money off of those folks, like from a margin standpoint, if you look at these numbers. Let's see, balance sheet. Here we go. What else do we have? Total. Let's look at total current assets. 190.8 billion. Look at all this cash it just has. $78 billion of cash and cash equivalents just sitting around. um, Amazon's just a cash cow, right? Um, it doesn't have a huge goodwill calculation, which I like, and it probably can justify something higher. But $624.8 billion of total assets versus total current liabilities, and you add up the rest of these, it's like what, 2.5, 3 to 1, which is a great asset to liability ratio. I think this is maybe the second best asset to liability ratio other than Meta. So I like Amazon too. The main issue, so in its conference call 30 minutes after, they reported that forward guidance isn't going to be as they don't know if their growth is going to continue at the same rate due to these tariffs once again that were just placed on August 1st on a lot of these other countries that don't have a deal with the U.S. yet, and just the tariff uncertainty, and even some of the agreed upon deals, where there was a 15% agreed upon tariff, that's still going to hurt companies like Amazon that are logistics companies for a lot of these physical goods and things of that nature, right? So that's something just to kind of watch out for on Amazon. But I still think it's a great buy. I probably would buy Amazon over Apple just because I think I I don't see Amazon going anywhere anytime soon. It could start to squeeze margins if it wanted to extract more money out of this $100 billion number that it has. And AWS and cloud computing with AI growing, I don't think that's going to stop either. And let's see one thing. Let's see about their capital expenditures too. I don't know if they're to see if there's anything in here about that. Uh, well, it looks like they have some new agentic AI offerings through AWS. AI agents. Interesting. Da, 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 da. Seems I can't find anything about their specific capital expenditures, but they are also talking a lot about AI as well. But I would like to get like the specific number that they're spending on it. And this is for me once again to see whether or not um, they intend to spend more on cloud computing and AI services, which would mean that they're probably going to be spending money on chips. And I'm heavy chips right now, so um, yeah, Amazon, that's the fourth company that we talked about. I actually like them all, right? All of them. And so this is one of the things that I was looking for to see if are we going to slip into a bear market potentially, or are we going to keep continuing into a bull market? And yes, we had that big pullback on Thursday and Friday of last week. I think specifically Friday. But does it seem like these companies are extremely overvalued, and their earnings reports, they keep like reporting earnings beats and they keep growing revenue. So if all of these massive companies keep growing revenue, I don't see any sign that that's going to stop in the future. So for me, I'm still somewhat bullish, even after this big drop on Friday, and with the seasonality coming up on in August and September, which can tend to have some of the down months. I still like these things long term, where I'm going to be looking for these pullbacks to come and figure out where I want to get in. It's funny. The first thing I have up is Lilly. Lilly has been the one company that's been evading me. It reports earnings next week, I think on Thursday or Friday. No, probably Wednesday or Thursday. And I still want it at 650, but this thing just keeps popping up right here at around 725. We'll see if I have a chance after earnings to grab it if it dips, or if it just takes off after earnings, right? If you're looking at specifically, let's go pull up Microsoft. Microsoft all time high. So, or at least it hit all time highs recently. Let me go redraw my fib levels. Of course, I want to buy Microsoft. My issue is always the price. Let's see, what was the low? Change this to a monthly chart. The low is 196.25. My rules, I don't buy anything that's not at least 40% off all time high. That's my personal rule. I'm looking at my to get in at Microsoft if I could get it to dip to like 420. That would be my price on Microsoft. And looking at all that support and resistance right there around that 418, 420 level, I'd get in a couple dollars before. So my level at Microsoft would be at like 420. Will it ever come back down there? Who knows? Sometimes we have some of these September dips. Maybe one of these September dips gets us down there. That's where I am on Microsoft. On Meta specifically, Meta hit a new all-time high too. Let's see, 784, 75. Honestly, I think this is the best in class out of the one that we've talked about. Just because the business model, I foresee more people spending more money on Meta, Instagram ads, WhatsApp ads in the future, Messenger ads in the future, Threads ads in the future. I foresee that that's going to happen. And they don't spend any money doing that. It's a software. It's internal. Like they don't even need any more employees for that, right? AI is programming a lot of that for them. So I love Meta. Same thing. My price on that. Look at a lot of support and resistance at this fib level here, around 520. So my price for Meta be a couple of bucks above this fib level where I see some support resistance here, 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 and it's on a monthly chart here, 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 and here. So 520 would be my Meta level, right? Let's look at Apple. Apple's the closest to potentially getting to a point to where I would buy leaps on it. Didn't fare so well after the earnings report, even after it beat expectations. But I like Apple personally at 165. The reason why that's my price is because I got in there previously, like right here, I think. Yeah, and that led to a really great swing for me previously on Apple. And that level looks like it's still there right here, even it dropped almost there. So I like where it is right here. You could get in at this fib level here at 181-ish, 182. But I like Apple again at 165, right? Just because of, once again, it just was a one-trick pony too with the iPhone. And so looking for something else. But that 181 level looks promising too. And it's closer to that, 40% off. A lot of support or a lot of resistance here at that 181 level. A lot of support and resistance revolving and wrapping around that 181 level here too. I like 165, but yeah, that 181 looks good too. So 181, 182 on Apple. A really good price for Apple would be 165. And lastly, let's look at Amazon. Amazon, I like at 181, 182, couple bucks above this fib level. Previous support here, right? And resistance. And way out here as well. A lot of resistance at that 181 and 182 level. So if Amazon could come there, I would think about buying some leaps on it there. And specifically with a lot of these stocks, like if possible, I would like to get in with some leaps rather than just buying the stock outright. Give myself a year, give myself some more leverage. But I like all of those right there. In fact, I might go and set some alerts. And lastly, some other targets I've been looking at. CRM. I have a target at 150, or I'm sorry, 250. Thinking about getting in CRM actually next week, or waiting to see if it could drop to like this 230 level, which would really like be great if I can get it at 230. And the only reason why I'm not potentially going to buy a 250 is because from a seasonality standpoint, if the market's dropping and we head into September, we usually see a little softening. So I might wait a little bit, just because if I just look back the last few years, if I would have waited till September, a big drop day to buy in September, typically like on almost anything I would have been looking at, I would have done well. So I'm thinking about holding off on some of a potential trade on this, even though it's hitting my level, and the leaps look good. I'm thinking about maybe waiting until September to get into a Lilly, a Microsoft, an Amazon, a Meta, to see if I can get a dip on something that I believe in a little bit more. But I really like this trade right now. It's setting up perfectly. It's at the level, it's 40%, no, it's 50% off. The company makes money. It's profitable. CRM, Salesforce specifically, it has earnings coming up in a couple of weeks, on August 27th, so 3 weeks from now. And I love like the dip into earnings is likely going to run into earnings. I'm almost convincing myself to buy this next week. It's it's dipping, but this is exactly what I want to see coming into earnings, which means his expectations aren't going to be huge either. And Salesforce makes money, so I assume it's going to just have some steady growth, and it might be one of those stocks that like booms post earnings. So that's why I'm looking at Salesforce. It's 50% off, so you're not buying it at an all time high. 50% off is all time high. Um, yeah, this is probably my main target. I might throw some money into this account by this next week, especially if it hangs out or dips a little bit lower. But I love this fib level as like an area of support, like right there, right there, right there, right there, right there. Even in the past, right here, right here, and this is monthly support too. So I think this is a really good area to get in. 230 would be an even better area right here. But yeah,
At that point, load the boat.
yep, yeah. I like it, and I understand, and more so because I researched the fundamentals. Like the earnings are growing too, so it's a company that is $1 billion company, first in class in CRM and the customer relationship management space. It's software, so the margins are pretty decent, and so yeah, it looks the part, right? Even if it comes down to this fib level or whatnot, I'd be comfortable because it has all this space to kind of come up. On a weekly chart too, I think I saw this too, that 200 week average, it bounces off of there and it's like right there, you know. It's been pretty consistent. So yeah, I almost got in on Friday on that big dip. I love those big pullbacks, but yeah, this is a smooth of a potential trade. I might even like scale into this. Like I might buy one leap here at 250 and then wait to potentially buy another one at 230 if it comes down and like average into it. Then I feel better about myself if it drops further. You know what I mean? Cause look at these right here at 230. There's some more levels right there where it bounced up previously. So I love that price, but I don't want to miss it either. Like, cause if it just bounces off this level and keeps going, cause usually, so what? It's what, 3 weeks into earnings. Usually 2 weeks into earnings, it's gonna rise. It's like most of these stocks start rising into earnings, so this has already kind of suffered some weakness all the way from its last earnings period into here. So this would be a perfect time if it makes a significant beat and gets back up closer to that all-time high. Like I'll tell you how I play it. If I buy the leaps right here, this is going to be target one right here at the 317 level right before. I might sell at 315. If I were to buy, let's say, two contracts, I would buy two contracts. Maybe I'd have a stop right here at this 219. Probably not. You know what? I haven't really been trading with stops on my leaps because they're a year out. That's why I invest in companies that I think are actually like good companies. So I probably this would be like my mental stop. I'd be getting nervous if it dips below 219. Um, but I buy it here. I get nervous if it dips below 219. My first target would be this 317 number, almost like a 2 to 1, and then I keep a runner, hopefully to get to the all-time high and or keep going. You know, that's how I'd play it. It'd be even better if I got it right here at 230, and then swinging it all the way up to like that 317 to at least get out of half of my position. Because look, there's going to be significant resistance here. Like right here, there was, and right here, it didn't even hit it right there. So I know I'm probably trying to get out. What's this high? 310, shit, 315, probably 315. What's this bar? 310 to 315 is where I think about selling on my first target, and then I just keep a runner, and then maybe keep a stop loss at like 50% or break even or something like that to keep a runner. But that's how I play CRM if I end up playing it next week. I hope on Monday we have another bad day. It drops even further. If it drops even further, then yeah, that 230, I'd be more comfortable getting in at 230 than at 250. But that 250 looks nice, you know.
And you still looking at those expiration dates out that you put in the group chat?
Yeah, I'll show them to you real quick. Um, the June 18th had the most liquidity with a higher delta. Delta 74, which I love. I usually want to trade leaps in the money. I even like something with a 90 or 80, but there's nothing in the 80s or 90 with sufficient liquidity. So here's the best one right here that I found for June 18th. Not quite a year out, but close. Specifically that 220 strike. You got, 1,600 open interest there, which is enough liquidity to be buying a couple contracts or whatnot, which is what I intend to do. And then the other one I saw, and then just to show you how I go through them, January, no liquidity there, so I skipped that one. And then I went to June, and I didn't see no liquidity now in June, so nope. And then December, man, I think the ones that I was looking at, they were in the money at the time. I think it was this one. I think it's out of the money, or I just don't see any liquidity. So really, yeah. Or no, it was December 2026. That's what it was where I found the other ones. It was here, slightly in the money. But if we go down to 230, that's going to be out of the money. And I don't like the Delta 63. So I probably, there's liquidity here. So you could take this one. The options are cheaper. But I like to be deeper. And I don't see anything with liquidity deep in the money. Maybe in this one, the 906 is fine. It's not quite 1,000, but it's still some decent liquidity. You could take this one too, which will, at least if it dips, will still be in the money and has a better delta. But I usually like my delta to be set. What, for every dollar move, I want to be getting 70 cents or more. So if I were to take this one, I'm probably going to take that June 18th because this one is further in the money. 220, even if it dips to 230, it's still going to be in the money with a delta of 74. So I'm going to get more movement for every dollar that CRM moves up, especially as it keeps moving up. So this is probably the strike that I'm going to take. It's the 220 strike on the June 18, 2026. Right. That's pretty much, I'm not going to even go into swinging next week. I would say watch your head. My disclaimer, once again, for this podcast is for informational purposes only. I might swing something next week, but we're still in the thick of earnings. Right, investing is risky, trading is risky. Do so at your own risk, and do your own research. I am not a financial professional or advisor. You should consult one if you have one regarding your trades and your investments. Right. We got tariffs coming back on, and it's been up and down with that. It's 15% one day, then it's 50%, then it's 100%, then it's back down to 15%. And this country is excluded, now it's not excluded, or now there's a deal with Mexico or Canada, now there's no deal with Mexico or Canada. So that's one thing where like swing trading has been very volatile lately because of that. I think that in addition to just the month changing, because I usually see a bunch of sell-offs at the end of the month or OPEX, which is what we had August 1st, which is why it didn't surprise me when we went down August 1st, is because typically people are rotating in and out of stuff at the beginning and the end of months, so that didn't really shock me. And then the tariffs coming back on August 1st on certain countries, right? Earnings too, we're in the thick of earnings season. We had most of the biggest companies in the world, or at least in the U.S. stock market, report in the last 2 weeks. The couple of big ones that are up this week are Palantir on Monday. We got AMD, I think, on Tuesday or Wednesday. We have Eli Lilly coming up this week as well. And then NVIDIA is the big dog That I don't know the exact date. It's not this week, but that's the last shoe to drop is Nvidia earnings, and Nvidia usually reports late in the earnings cycle, but that's the last massive company to report. But so far, so good in terms of like all of the big massive companies, with the exception of Tesla, are making money. The Google, great earnings. Uh, Meta, great earnings. Microsoft, great earnings. Apple, even great earnings. Amazon, great earnings. With not so great forward guidance, but in terms of the money they're actually making and growing revenue and profits, uh, the bigger companies are still growing, right? The next thing that might lead to some volatility next week if you're trading is the unemployment numbers. If you were listening to the Fed chair speak last week, which I was, that was the main thing that he seemed that he was concerned about was the employment numbers in terms of whether or not he's going to lower interest rates or not, or keep them the same. So if we see some weakness in unemployment numbers, then we could see interest rates coming down a little bit sooner, which is going to be good for stocks and equities. So that's something that I would look at for as like a catalyst next week as well. And if you're building your watch list, like I've said a million times, I go to koifin.com. I go to their U.S. sectors. I check off all the sectors that I trade. Right, the hottest sector right now is XME, but a lot of the companies didn't report great earnings last week, so you saw that huge dip. And with the rotation and coming into these the months that are seasonally not so great, right? And seeing the things that are gaining, XLU, that's safety, right? So I might trade XLU, um, oil down. And I didn't even check Chevron and Exxon that reported Friday, but apparently they didn't do so well if the whole sector looks down that way. Chips down after last Friday and the tariff announcements and things of that nature. And I just think they were so hot that they're pulling back a little bit. Tech down, at least on Friday, right? A relatively flat. So really, like this week, from a swing trading standpoint, I don't know if I really want to trade anything. Everything's kind of neutral, right? I don't. Other than these two sectors that are like that were up, metals and mining, utilities is the only thing kind of showing some strength. Everything else is kind of in no man's land. Even like healthcare, which is usually safety, isn't really up. Probably waiting on Eli Lilly to report, which is a big the segment of XLV in the healthcare sector. But yeah, I see a bunch of blah or a bunch of yeah, flat. So I don't know if I really want to swing trade for me personally until I start seeing a trend, because I'm a trend trader. I want to see a trend, a strong trend up or a strong trend down. I don't really see any strong down trends. I see a lot of flatness, oscillation. And so XLU seems to be the only thing that I might kind of look at to actually swing if it has some liquidity. But then when I go searching like this, it turns out that the one place that's up is the one place that generally has liquidity. Look at that nice trend right there, right? It's trending pretty well. So I bet the options probably have a little liquidity in them. Yep, they do. Plenty of liquidity. So XLU might be the only thing on my list at these places where there's actually some liquidity in the options. But you got to watch the spread. I don't like the fact that the bid and the ask are so far apart. But when the market opens, these will probably close a little bit. Or you just got to be very precise with your bidding. You can't slap the ask on these. You got to actually put in a limit order at a price. Like for instance, if this 220 and 264, the last order was at 245. I will put in a limit order around 245 rather than buying the ask right here at 264 to make sure you get a good price and don't lose so much money entering the trade, right? So XLU might be the only thing I might want to swing. That'd be on my radar, at least as of Monday, unless we have a big Monday or Tuesday in a particular sector. XLU might be the only thing I might look to swing next week. Feel me?
Yes, sir.
All right, that's it. That's all I got. Unless you want to look at something.
Nah, that was a good game right there. Like you said, we're just gonna watch it, look for that next trend, and follow that.
Yep. All right. Mokama Sunday service, making it rain without the umbrellas. Till next week, 8 a.m. We do got some more earnings coming up next week. So I do have some more content. So it's easy. Earnings season is always easier to make content because you got some new data that came out. So we can just kind of look at it. These last two episodes have been more fundamentally based. I do go in into some technicals too, but mostly from a fundamental standpoint. Recently, I've mostly been focusing on trading long term leaps in my long term account because that's where I've been making the most money. Specifically, absent that last Friday, I was up what few 30,000. Now I'm up 24 this year, which has still been a pretty good year because we had two really great years previously. So I was actually expecting a down year this year, but I'm still up 24 bands, 25 bands, and I would have been even more absent that Friday dip. But I'm expecting some of these names to keep going up. I'm thinking about cutting my ASML though, to be honest. This has been the one drag on my account, and I'm thinking about cutting the ASML for a CRM or for Eli Lilly or for a pullback in Amazon or Apple. I think I'd rather have that than ASML because this is with the tariff hit that the European or with the Eurozone has been going through with the Trump tariffs. Even though like chips have been going up, ASML has still been a drag, and I think it may be like tariff related. So this is the one thing I've been thinking about cutting. Everything else has been gravy. But yep.
Nice.
All right. Deuces. Till next week.
Appreciate you, big dog.
Yes, sir.
Always. Good
Yep.
game.
Peace.